remembering that normally the adjusting entries can often be thought of as a separate entity, such as the public accounting firm, CPA firm, tax preparer, getting the information from the bookkeeper or accounting department, possibly with the help or use or access of QuickBooks or Xero, extracting the information from the software, putting it into their Excel worksheet, which I would still typically do even if I had access to the QuickBooks file or Xero file, so that I can see the adjusting entries in a more transparent two-dimensional way as opposed to within a database program. Although normally I would use debits and credits, here we're basically using the accounting equation in a similar fashion. Remember that even if you did both sides yourself, you did your own bookkeeping, you did your own tax preparation, you still might want to think of it as two separate activities, because they're basically having different primary objectives. When you're doing the data input, primary objective, dealing with the people you have to do business with, employees, vendors, and customers, as well as automating the process, making it as unintrusive in the operations of your business as possible, while still providing the information you need. Whereas when we get to the end of the year, we are looking to create the financial statements in the format necessary, which might be accrual format for external reporting purposes, possibly for the bank or investors, or in the tax basis, at the least, for tax preparation. Now, normally, therefore, the cutoff date might be the end of the year. Our cutoff date is going to be at the end of the second month of operations, because that's how much data we have, right? We've got 2 months. We're going to do the financial statements as of the cutoff 2/28 or 2/29, depending on the leap year or whatever in our generic problem.